So if you're buying, so you have bought machines, right? With machines you'd be able to produce more number of goods, right? And that will bring you faster capital back into your business, and that is why this is generally classified as an asset. Okay. Like I said, not everything is an asset. For example, um, if you buy something which is okay for personal consumption, right? Just to, you know, okay. So if you buy, let us say a laptop, okay, which is going to earn you, okay, you're going to do a lot of freelancing and earn a lot of money out of it, then this will be an asset. But if you buy a laptop for, you know, just watching movies and, you know, for consuming online content and all, right, which you don't intend to make money out of, you know, so this will be mostly an expenditure, okay, and not really something which is going to generate any cash flow for you. Okay, so the same thing but in a different context might mean something different. So whether or not something is an asset, it depends on a context, right? So I hope this is clear for everyone, right? Not everybody may be from finance or accounting background. That's why I just wanted to start with a simple concept of asset. Yeah, let me know in case anybody has any doubt. Right. So that we have started with asset, let us go to the next topic. The next topic is, you know, classification of assets. So assets can be classified. There are two kinds of assets. I mean, there are many kinds of classifications, but in the context of derivatives, we are seeing two kinds of assets. Okay, we are seeing real assets. Okay, and then we are seeing financial assets. Okay, so real assets are generally, you know, tangible assets, right? Which you can touch, feel, and all of that, right? Uh, these are tangible assets. These are non-tangible. Okay, so these are subject to depreciation. What it means is the over a period of time, the asset is likely to lose the quality and all, right? So, for example, if you have bought uh, a, a, let us say you are a Ola Uber driver, right, and you have bought a car. So over a period of time, your car depreciates in value, right? So that is what we would call as depreciation, right? Generally, financial asset, there is no depreciation. Okay, and I'm talking in very loose terms. Okay, I'm not talking in very strict cost accounting terms and all. This is just for a very high level understanding. Okay, and so you have real assets which are subject to tangibility. They are subject to depreciation, right? And can what can I say? You need to physically transfer it, right? And here you can do both physical and digital. So example of real assets, like I said earlier, right? So you have some kind of machines, right? Or you have your laptops, right? Anything which you can physically touch. Okay. So maybe your cricket ground is an asset. Okay. You have a big marriage hall, right? It's an asset. Uh, Function hall, something like that. Financial assets examples are, you know, stocks, bonds, okay, and so on and so forth, right? So you have real assets, financial assets, okay. And one major difference is, you know, real assets have bucketed quality, uh, and here there is nothing like, it is uniform across. Okay, and let me explain what I mean by this. Okay, bucketed quality means, let us say if you buy a physical asset, physical real asset, like gold, right? So gold comes in various qualities, right? So you have 18 karat gold, okay, you have 22 karat gold, okay, and then you have 24 karat gold, okay, and so on and so forth. But if you buy a stock of anything like, say, Infosys or TCS, for any firm, right? Then that stock, whether, so there is no quality differentiation between them. Okay, apart from, again, there are a lot of technicalities, right? There is preference A shares, B shares. So I'm not going into that, but in general, a stock of Infosys is uniform, right? There is no quality difference between that. Okay, so when someone is delivering a gold to you, you will always ask what is the purity of it and all of that, right? uh, but when someone is delivering a stock to you, it means the same thing across, right? So it is fairly uniform across, right? So this is just a basic classification of, various assets which we have. So you have real assets, and then you have financial assets. uh, any doubts so far? Can somebody confirm
No, sir.
that, yeah, that you can hear me or not? Okay, thanks. So let us continue with this, right? So we are covered with a very short introduction of, you know that there are real assets and then there are financial assets. Okay, so I'll just cross it out, and you know I will, what I'll do is, so I'll do this, and let me let me mention it here. Okay, so there are assets which can be real or which can be financial. Okay, so once we have defined assets and derivatives, assets and their classifications, right? Then we can go to the definition of derivative. So derivative is a financial contract. So derivative is a financial contract with with an asset as an underlying. Okay, so it's called derivative because it derives its value from the underlying. Okay, so one essential element for derivatives to exist is for the underlying to exist. Okay, derivative themselves are financial contracts. Okay, there are no real derivatives, kind of thing. Okay, so derivatives are financial contracts. They have an asset as an underlying. So for example, uh, whatever is a derivative, right? So derivative is it's a function of some underlying and some function of an underlying. Okay, now if you keep changing functions, then you keep getting different kinds of derivatives. Okay, so for example, underlying keeps changing, the price or the value of your derivative keep changing. So that is what it means by derivative being a function of an underlying, right? So generally, apart from underlying, there is one major factor which is present in every derivative, is the fact that derivative is a time bound contract. Okay, so every derivative is a function of underlying and time. to expiry of that contract. Okay, so this is the very broad definition of what derivatives mean. Okay, so let me write it down. D is equal to function of asset. Now note that this underlying can be any asset. Okay, this can be both a real asset and this can be a financial asset. Okay, so you do have derivatives on something like gold, crude oil, okay, and so on and so forth, metals, and you also have derivatives on stocks, bonds, okay, FX, and so on and so forth. Okay, so you have you have, so these are broad examples of various derivative contracts. We'll go in detail of all of this, but this is just a basic motivation of what derivatives is and what financial contracts are. Okay, now let us come back to I mean, people give a lot of conventional examples, and conventional examples for derivatives would be like, there is a farmer, he grows wheat and all of that. Okay, but for our class I thought, I should come up with a different example to build the same motivation. So we'll come up with a different example and let us see how it goes. Okay, so motivation or derivatives, right? So you have all kinds of financial assets and real assets in the world. Then why do you need derivatives, right? So let us see. Now let us take a very different kind of underlying. Okay, you must have seen in the past year, right, 2023, that a lot of movies got released, right? So depending on popularity of those movies, right? If you go to a very popular theater, right, which showcases these movies, you will find that depending on popularity of movie, the ticket prices, okay, fluctuated significantly, right? I don't know, I just read a few newspaper headlines, right? For some very popular movies, the ticket prices for a particular show, first show, maybe went up to rupees 1000, 2000 rupees per ticket. Okay, and for some of the movies it was as low as rupees, I don't know, 200 rupees per ticket. Okay, so if you look at this as a probability experiment, right? So at the start of, let us say at 2024, right, we don't know, let us assume, right, we don't know what all movies are going to come up. Okay, we don't have any extra information, right, that which movies are going to be released, right, when, and all of that, and how many movies are going to be there this year and all of that, right? Let us say we don't know, right? But looking at last year, what we know is if the movie is going to be a very popular movie, right, then the ticket prices can go as high as rupees 2000 per ticket. Okay, and if it is not a popular one, then it can go low as rupees 200 per ticket, right? So our omega, right? uh, so so the probability experiment is, you know ticket prices, right, for a movie, right? So the omega for this, right, experiment is, okay, it range, so it is discrete integers, right? We never have tickets as rational numbers. So omega for our experiment is, it ranges from 200 to 2000, right? And any multiple of that, right? So we can have 400, 600, 800, whatever, right? And up to 2000. And then there are probabilities associated with that, right? So some PIs, right, for each of it. So P1 to Pn, right? Such that some, again, all of the things which we had discussed earlier, right, exist. That all of them are greater than zero, all of them are less than one, and sum of it is equal to one. Okay. So there is uncertainty associated with the outcome. Okay, you don't know whether it is going to be this, and everything has a probability associated with it, right? So there is an uncertainty, right? So let us say you enter into a contract. Okay, you as an individual, you are a moviegoer, right? And you want to watch every single movie which is going to be listed. Okay, and again, for sake of simplicity, we have few assumptions that you can go only to one theater. There is only one theater. Okay, and you do have no other choice but to take whatever price has been listed. The price depends on supply and demand and popularity, right? So some simplifying assumptions. So as an individual who is a moviegoer and who wants to go to every single movie, right? There is an uncertainty for you as a person that what kind of ticket price is going to be charged, and there is an uncertainty for the theater as well, right? Because they also don't know what is going to be their revenue and all of that, right? Uh, so what you do is both of you enter into a contract, right? And the contract states that, based on looking at historical data and all, right? So you agree that, so you agree to buy every ticket from theater at rupees X. Okay, and this agreement is made on 1st Jan 2024. Okay, for all the tickets from 1st Jan 2024 to 31st Jan 2024. Okay, so the contract is that, agree to buy every ticket. You agree to buy a ticket at X rupees. Okay, for sake of simplicity, let us assume that, that turns out to be, let us say, rupees 400. Okay, so you say, irrespective of the quality of movie, right? I commit to you that one seat will be bought by me for rupees 400, okay, per ticket. Okay, throughout the year for every single movie that gets listed, right? So now what happens is, if that is a year of all blockbuster movies, right? All blockbuster movies, right? Consequently, in Omega, most of your realizations are, above 400, right? So 600s, 800s, and thousands, okay, up to 2000s, right? This is what actually happens, right? So, and you have bought all the tickets at 400, right? So you stand to gain out of it, right? Because you already have bought them at 400, whereas actual market price of them when the movie gets listed is very different, right? It is 600, 800, 2000, whatever, right? And this makes you, so you make, so consumer, you know kind of wins this contract. I mean, it's a financial win for him, right? And this is at the cost of the theater, right? If theater, instead of selling this contract, if he would have actually sold it in market whenever the movies would have released, then that guy would have made more money, right? So consumer wins at cost of theaters. Okay, similarly, if that was not so good year, right? And all omegas were like hundreds, 150s, so on up to barely anything reaching up to 400, right? In that case, theater would have won, right? Because he would have locked in, and this guy would have to pay 400 and all. So theater wins at cost of consumer, right? So I hope everybody understands this argument. Okay. So so the point that I'm trying to make is, derivatives is a zero sum game. What it means is one party wins at the cost of other. Okay, so someone has to lose for someone to win. Okay, unlike stocks, okay, stocks are not a zero sum game. So if you buy a stock, it's not necessary that someone has to lose. Okay, you buy a stock at 100, you sell it at 200. The guy who is buying at 200 can wait and hold and hope for it to go up and sell it at 300. Okay, so both of you make money, right? And you can keep going on infinitely, right? But that's not true with derivatives. Derivatives are time bound contracts, and there is party A, there's party B. It's a very clear cut transaction that party A will win or party B will win. Okay, and one wins at the loss of other, right? So derivatives is a zero sum game, right? So let me write it down. So derivatives is a zero sum game. Okay. So these are basic features of derivatives, right? Any questions so far?
No, sir.
Okay. So now let us try to enter into something more involved than basic motivation. So let us look at, you know, we'll even close this out. Now let us look at futures as one of our first financial contract. Okay. So futures are as our first financial contract. Okay. And let us keep the stock as the underlying, right? So stock with stock price S at small t is the underlying. Okay. So future contracts generally have expiries of, you know, which have monthly expiries, right? So 1 month, 2 month, 3 month future, right? And expiries are on specific dates, right? Maybe third or fourth Wednesday, third Thursday, something like that, depending on markets. Okay, so they have specific expiry on a specific day. So what it means by entering into a futures contract, right? So let us say you are a person who buys. So let us say that currently the stock is trading at 1,000 rupees. Okay, so this is at time small t, which is before expiry of that contract, right? Now the point is you have two options to get exposure to the stock, right? What you can do is you can go into the market and you can buy this stock, one stock of rupees 1,000, right? And whatever happens at expiry, right? This stock can take set of values at expiry. and you sell the stock, then your profit or loss is given by ST minus T, right? So at expiry, this could be at 1200, 1000, right? 900, and so on and so forth. Depending on where it ends, you're going to have some profit or loss, right? So this is called as payoff of your transaction, right? So, but this is buying a simple contract, not even a contract. This is simply buying the stock. Okay. The another way to do it is you can go long on futures contract on the same stock, right? And the way it is defined is, okay, you don't pay any money upfront. Okay. But all you say is you enter into this contract with another party, right? So there is A and B. Okay. So A is long on ST and B is short on ST, right? So the contract states that you're long on futures, which is ST, right? So nobody buys stocks or nobody sells anything. Okay, all they say is let us start our bet at this point in time, right? Where the initial price is 1000, right? And let us observe whatever is at expiry, correct? And whatever is the difference, I'll be paying to you on expiry. Okay, so you're long on futures on ST. Okay, at time t is equal to small t, right? So the value is 1000. Okay, at expiry it can be a range of values. Okay, if it ends up more than this, then guy A has won, so he'll end up getting whatever is the difference. If guy B wins, then it is a difference win for him. Okay, so essentially whatever is the difference, A pays to B or B pays to A. Okay, depending on who has won. Okay, so such a contract, okay, so such a contract can be called as a forward contract or a futures contract. Okay, we'll see the difference between the two. Okay, but in terms of the nature of contract or definition of contract, it is very similar for both of them. Okay, so where you don't, so you bet on ST minus ST. Okay, and there is no exchange of cash flows until at time capital T. Okay, so okay, the major difference, okay, between, we'll discuss in detail forwards and futures, but the major difference is forward contract is a bilateral contract, okay, which is only between two people, right, between A and B, whereas futures contract is exchange traded, right? So you will route your order of buying a futures contract to an exchange. Exchange will find a competing buyer. Okay, both of you will agree on a price, and once you agree, the trade is executed and everything can be traded thereafter on the exchange, right, and not between each other. Okay, so this is the difference between a futures and a forwards contract. Okay, so let us go and see some futures contracts. Okay, so let us say we are on National Stock Exchange, right, and here we are seeing exchange traded futures contracts, right? So let us see contract specifications. So this index futures contract, okay, is on Nifty, okay, Nifty 50, okay, Nifty 50 spot price, which is, let me write it down. Okay, so ST is trading at 21,731, right? So 21,731. Okay, and we have for futures contracts. Okay, we have 3 futures contracts. One, okay, so the first one expires uh, on 25th Jan 2024, right? Second one expires on 29th Feb 2024, and third one expires on 20th March 2024. Okay, so they trade at respective different prices. Okay, and we are going to see at how to arrive these prices. Okay, so now let us try to build an argument for what should be the price of a futures contract. Okay, so what we are going to do is we are going to build on a no arbitrage argument on what should be the price of a futures contract. Okay, so let this go away. Okay, so at time t is equal to small t, right? Let us say you have two options. Okay, first option is to buy a stock at st, right? And then you don't know what is going to happen at s capital T. At capital T, you don't know what's going to happen, but it's going to lead to st, right? And you can enter into a futures contract where you're not paying anything at t. Okay, but at capital T, whatever was the price, okay, you're just going to take the difference, st minus st. This is also uncertain. For sake of simplicity, we'll keep this number simple, right? We'll keep this number as 100. Okay, so you can buy something at 100 and sell at whatever future states, or okay, you don't even pay anything for buying that, and then you have future states, right? So for sake of simplicity, right, let us keep this as 110, right? And consequently, this is also 110. Okay, so if you have a futures contract versus a spot, right? What do you think is the difference between the two, right? Where would you be paying more money and where would you be paying less money? Okay, to I mean you have to talk about the price of this futures contract related to this 100. Okay, so can somebody present an argument, okay, for this?
Sir, repeat the question once.
The question is, okay, you have two choices. Okay, the first choice is you can buy a stock which is trading at 100. Okay, the possible value that it can end up is, for sake of simplicity, is 110. Okay, the choice which you have is you can buy a stock where you have to make an upfront payment of 100 rupees and eventually you might get 110, versus you have a futures contract, right? uh, where you're not making any payments upfront as of today. Okay, so what should be this future contract be trading at? Okay, so that there is no arbitrage between the choice of buying a stock, buy stock at st, or go long on future, which is ft.
Beyond 110.
So you're saying that futures price should be 110, is it?
Yes, sir.
So it is 110, right? Then how much money does a guy who has invested in future, okay, will end up making if the stock ends up at 110? We have seen the payoff of future is st minus t, correct? So this guy will make 0, right? And this guy will make 110 minus 100, right? So this guy makes 10 rupees, right?
Yes, sir.
So this does not look like no arbitrage price, right? Because if this future is trading at 110, okay, and here you are going to end up losing money, right? You would naturally switch to this stock, right? So you can short this future at 110, right? And you can buy this stock at 100, okay? Later you will get this stock back at 110, so there is no loss here, but you end up making profit here, correct?
Yes, sir.
So 110 does not make sense, okay? So let us look at the other extremity, right? If we keep this as 100, okay, so what happens is, you know, this guy makes how much money as per contract? Okay, as per contract, this guy will make 110 minus 100, correct, which is equal to 10 rupees, and this guy will make same amount, right? 110 minus 100, right, which is 10 rupees. Okay, so do you think this is the no arbitrage price, that this FT should be trading at 100 rupees? Do you think this makes sense?
No, sir.
Why?
So because when we are buying a stock, we have a stock like an asset, but in contract we don't have an like asset. It is just a contract.
So it is even better for you, right?
I don't know, sir.
Right, it is even better, right? So for those 100 rupees, okay, you are going to enter into a transaction, right? Give these hundreds, get a stock ST, right? Wait until expiry, then sell it back. Okay, here you don't have to do any such transactions, correct? You have to just enter into contract when it is at 100, right? And just get your money back. You're not doing anything with the stock.
Yes, sir.
Okay, I
Okay,
think
sir.
these payoff diagram should be a hint for you. Okay, what is difference between buying a stock, okay, and going long on future? Okay, final payoff is same for both. Okay, but there is a very important difference between buying a stock. We clear it up. So this is a diagram, payoff diagram of, you know, buying stock, and this is about going long on futures. There is a very critical difference between the two. Can someone tell me what's that difference?
Required capital.
Yes, exactly. If you want to buy a stock as of today, correct, you need to have 100 rupees in your pocket as of today, correct? If you don't have 100 rupees, you cannot buy this stock, right? So, you know, what this guy will have to do is, okay, let us say the guy is same, okay, and he has only two different situations. So versus buying a futures, okay, for buying futures, he does not need to have any money in his pocket, okay. But for buying a stock, let us say he even does not have these 100 rupees. What he'll have to do is he'll have to borrow these 100 rupees, okay, at rate of interest R, correct? So he will be charged an interest from time t to small t to capital T, correct? So he will be charged an interest of rupees 100 into, 100 into R into T minus T. Okay. So he'll be charged with this much of interest, correct? He'll be charged with this much of interest. So to, so if this guy's price is also not aligned with that, right, with this cost of capital, correct? So there is this extra component that gets added, correct? If this guy's price is not same as this, then there is arbitrage. Okay, you can go long on this, then you can go short on this, and you can make money out of it. I hope everybody understands this argument. This is called as cost of carry. Okay, so
Yes,
you are
sir.
carrying your long position. Okay, so versus a guy who is buying, you know, a stock, the guy buying futures has an advantage that he does not have to arrange capital, but he has to pay a cost for it. Okay, so he has to pay the price of the futures contract equal to the price of uh, the cost of carry of that trade, correct? Therefore, okay, you will find in most of your standard books John C. Hall and whatever you would read. Okay, if you solve for these arguments and all of that, if you equate it out and all, okay, so it turns out that your futures price has to be equal to your spot price into e to the power RT, where t refers to t minus t. Okay, so this is time to maturity. Okay, this refers to your risk-free rate. It is assumed that you can borrow and lend at the same rate, and this is your spot price. Okay, so this represents cost of carry, right? I hope everybody understands this argument.
Yes,
Okay,
sir.
let us look at it actually, okay, in the markets. So your first option is you can go and buy Nifty at 21,731. Okay, and you can wait until 25th of Jan 2024. Okay, at 25th of Jan 2024, if Nifty, let us say, is at 22,731, correct? So you have made 1,000 rupees by buying this stock, okay, and selling it 1 month later at 22,731. So you have made 1,000 rupees, but you have to pay back your cost of capital, correct? You have to pay back your interest. So you had borrowed 21,731 for 1 month, correct? So you have to pay certain rate of interest into 1 month. Okay, so this much amount of interest has to be paid. So 1,000 minus this is your profit. No arbitrage argument says that futures contract cannot make more money than that, right? So it has to trade at a premium. You're looking at this. If you want to go and buy a Nifty futures contract, okay, which has the same payoff as that of Nifty, okay, but the difference being here you don't have to pay any money, but I mean there's a separate thing called margin and all which you have to pay, which is a separate topic which we'll take up later. But point is, as per the contract, you don't have to pay anything to the exchange. Okay, you don't have to pay money to the exchange. All you have to do is tell the exchange that I'm entering into this contract, and if I end up losing, I'll pay you the money. If I end up winning, you have to pay me the money. Okay, and the same thing happens, right? On 25th Jan 2024, the Nifty is at 22,731. Correct. Nifty is at 22,731, right? So this guy would have made how much money, right? The guy who went long on the first contract, he would have made this minus 21,861, correct? A little less than 1,000, right? and the difference has to be equal to the cost of carry of that trade, right? I hope you understand this argument, right? Any questions here?
No, sir.
So looking at these numbers, what can we say, right? We can say that, you know, we can indirectly calculate what is the cost of capital, correct? We have all the numbers. The only number which is missing is R, correct? So we can calculate cost of capital. I hope everybody understands this argument, right? So futures price for Nifty of 1 month contract is at 21,861. Then S naught is at 21,731, correct? Your time to expiry is equal to how many days? This contract last traded on Friday. Yeah, so Friday means this contract was trading on 12/29/2023 and contract expires on Jan 25th 2024. So T minus T is okay. So I think it's roughly 4 days less, right? So it's roughly 26 days, right? So this is equal to roughly 26 divided by 365, right? So let us calculate R from this. Okay. So R will be, so can someone tell me how can we calculate R? So F at 1 month is equal to S naught into e to the power R, right? T minus T. So we'll get, you know, 21,861 divided by 21,731. If I take log of it, this has to be equal to R into 26 divided by 365, right? So all I have to do is take log and multiply by, you know, 365 divided by 26. Okay, so let us see that is equal to ln of 21,831 861 divided by ln of 21,731. Okay. So this minus 1, this into 365 divided by 26. Sorry, I think. So we have F by S into e to the power RT. So we take f by s log of this will be equal to r time to expiry also write it as f is equal to s into 1 plus r into t. So you have f by s into 365 divided by 26 is equal to 1 plus r. $21,861 divided by $21,731. It so is equal to this into so this actually should be -1 into this into 65 divided by 6. So this should be 8.4%. Okay, so 8.4% is the rate of interest which is being charged, annual rate of interest which is being charged for 1 month. Okay, I hope you get this argument. So
Yes, sir.
someone is borrowing, the money at 8.4 rate of interest per annum, and then he's borrowing it for 1 month. Okay, and then you will have to buy Nifty at 21,731. Then you have to wait until expiry, or equivalently you can go to futures market, but you'll have to buy it at a higher price. Okay, for the no arbitrage argument, right? So I hope you understand this, and consequently let us calculate the other rate of interest, right? And then we'll understand what it means by arbitrage and no arbitrage, right? We'll keep this as it is. Then you have equal to 21,999 divided by 21,731. Okay, so this -1 gives you this into 365 divided by 26 plus 30. This gives you 8% rate of interest, 8.04, and the third contract. Okay, so 22,135 divided by 21,731. This is equal to this -1, and this 365 divided by 26 plus 30 plus 30, right? This gives you 7.8% rate of interest. Okay, so for example, so these rates of interest are close and all of that. Okay, what happens if your future is trading at the implied rate of interest of one of the futures? Okay, so let us say instead of 8.48 and 7.89, one of the futures is trading at 4%. Okay, so what will be your strategy in this case to make money out of these contracts? Okay, so 4% annual, okay, for 2 months, right, will be this into so this is for 2 months, right? So 26 plus 30 divided by 365, this plus 1, right? And this into 21,731, right? So this future is trading at 21,864, assuming, right? Instead of 21,999, this future is trading at 21,864, right? So what is your strategy to make money out of this futures contract? Any money will be made by first finding whether it is underpriced or overpriced, correct? So if the rate of interest of a contract which is before that, which is 8.5%, right? The rate of interest of the contract after that is 8%. Okay, so this has to be somewhere in between these two, right? So this has to be at 8% something. But if this is actually at 4%, okay, so the fair price of this contract is supposed to be 21,999. Okay, but this contract is actually trading at 21,864, right? So how can you make money out of this?
Sir, I will sell after 1 month for maximum profit.
You will sell what? See,
For
firstly, you have to take action at ST. I mean, you have to take action today. Okay. Can you tell me how will you set up a portfolio today? What action will you take today?
sir, I will buy a contract one with 26 days.
Okay.
Hmm.
Then what will happen?
Sir, that one has 8.4% interest
Right.
rather than 2 months one having 4%.
No, so you will buy it, but how will you make money out of the fact that this is trading at 4%? Instead of 8%, let us say this is actually trading at 4%. So if it is instead of trading at 8%, this is at 4%. Okay, whether it is cheap or expensive.
It's cheap.
Yeah. So what will you do? So the essence of arbitrage is buy something which is cheap and sell something which is expensive. Right. So what will you do?
We'll buy it.
Yes, but you will buy, then you will have to wait until expiry and all of that, right? How can you lock in profit today? Okay, let me give you a hint. Okay, what happens if you sell this contract? Okay, you can go both long and short, correct? What happens if you short this contract? Okay, contract of 28th March 2024. If you short this contract, okay, essentially you're earning a rate of interest of 8%, 7.89%, correct? Because if you're going long on contract, you're paying cost of carry, correct? Similarly, if you're shorting, then you're receiving cost of carry. And at the same time, if you buy this contract, okay, which it should be trading at 21,999, but it is trading at 21,864, correct? So for this, how much cost of carry are you paying?
4%.
Right. So you're paying 4% and you're receiving 8%, right? So you're locking in your profit as of today itself. You
Yes,
understand
sir.
what I'm saying? Now, whatever happens for this, okay, so this contract is going to expire first, correct? So let us say, okay, so this contract expires on 29th Feb. This contract expires on 28th of March. Okay, what you can do is you can close out your position of this third contract at the expiry of the second contract. Correct. So you buy both these contracts. So at small t, okay, small t is 29th December 2023. Okay. And capital T is 29th Feb 2024, right? Here you buy cheap, right? So cheap is the Feb contract, right? And sell the March contract. Okay, and at you don't wait for this contract to expire. Okay, this contract expires in March. Okay, but you don't wait for that to expire. You close out both these contracts on 29th Feb 2024, correct? So you close out both the contracts, close out this. Okay, now tell me at 29th Feb 2024, what will be price of Feb contract? Okay, how do we tell what?
21,009.
No, it will not be that. Okay, it depends on S capital T, correct? Right? The price of futures contract does not mean that on 29th Feb 2024 the price is going to be this. Okay, the futures contract means that instead of buying the stock, if you were to buy futures, right, and wait for expiry, okay, on expiry it can go both up and down, correct? The Nifty might actually end up at 20,000 or it might end up at 22,000. No one knows that. Okay, but wherever it ends, the no arbitrage price of that contract today is 21,999. Okay, so if you have bought a Feb contract, okay, and you have bought it at 21,864, correct? And if at expiry, right, if at expiry Nifty is at 22,000, right, then how much money you would have made here? This minus this, correct? Now, what happens for this contract? Okay, this contract is at 22,135 and closeout is S capital T, right? So for this contract ends, let us say 22,000. Okay, so this will not end on 22,000 because this contract still has 1 month of expiry, correct? So whatever is the 1 month of interest and all of that, right? Okay, so let us assume that it is still at this rate. Okay, so at this rate you will have, so this into 26 divided by 365. So this plus 1, okay, and you have this into this. Okay, so 22,000. So this will be the fair price of this contract at this time, correct? I hope everybody's following these arguments. If not, you can stop me and ask again. Okay, so if you close out this position, you had, this was a short position, right, on this contract. The short position gains out of falling position, right, or falling price, whatever, right? So this difference is actually a profit for you, which is 4 rupees profit, right? So you end up making a profit of this plus this, right? So you make this profit, right? So I hope everybody is getting this argument.
Yes,
If you
sir.
don't get this, you can let me know. Okay, I just showed it numerically. Okay, but the intuition behind making this profit is the fact that here, okay, you're making 8%, you're making 7.89%, right? And here you're paying 4%, right? So difference between these two is going to be your profit, right? So when you are in futures contract and when you have different futures contract, correct? You have futures contract for 1 month. So you can understand futures price as this. Okay, so futures price is equal to spot price plus cost of carry. Okay, I'm just writing it heuristically. Okay, so if you have futures price at 1 month, this is equal to spot plus cost of carry for 1 month. Okay, this is important. Then you have futures price at 2 month. This should be equal to spot plus cost of carry at 2 months, right? And futures at 3 months is equal to spot plus cost of carry for 3 months. Okay, cost of carry is represented by spot into rate of interest into your time to expiry. Okay, so this is 1 month by 12 months and so on and so forth. Okay, so if you're, so naturally speaking, your cost of carry for 2 months is always going to be more than cost of carry for 1 month with the same rate of interest, right? But if these are with the same rate of interest, also if this is substantially different, right, then you can make arbitrage out of it, right, depending on which one is greater and which one is smaller, right? So if you go long on this and short on this, okay, so what happens is, you know, so it is F2M minus F1M, right? So your spot cancels out and what you're left is cost of carry for 2 months minus cost of carry for 1 month. Okay, now this has to be proportionate, right? If the both of, so this is equal to spot into some rate of interest, okay, into 1 month upon 12. This is minus spot into some rate of interest into 2 month upon 12. Okay, if rate of interest is same, okay, then this is simply equal to spot into R, okay, and time difference, right? So 2 month minus 1 month upon 12. right? But if this is not true, right? So if, for example, this total value has to be generally greater, right? This has to be smaller, right? But if instead what happens is, if this is substantially higher, right, and this is substantially lower, right, then what happens is, then there is an arbitrage, just like I explained above, right? So if your implied rates are incorrect, right, if your implied rates are not right, then you can have an arbitrage, right? I hope everybody understands this argument of cost of capital.
Yes,
If
sir.
not, if not, you can ask questions here. Okay. So what you're doing is you're looking at futures prices and you're finding a futures contract which is mispriced. Okay. And then you're entering into positions which give you profit. Okay. But for your information, right? Entering into long on one futures contract and short on other futures contract is called as calendar spread. So you can look up for this strategy, right? So calendar spread essentially tells you to go long on one of the contracts and short on long. So there are technical terms, right? This is called as near month contract. This is near month contract, 25th Jan. This is mid month contract, and this is called as a far month contract. Okay. So you can go long on near month contract and short on far month contract, and so on and so forth. So all combinations you can do if you spot that there is arbitrage between the prices. Is there any doubt so far? Are there any questions so far? Okay, no doubts. So let us go back to our set of formulas. Okay, I'll just clean this up, or I'll keep this because you may require it for future reference. Okay, let us pick a separate thing than this. Okay. Now let us talk about various asset classes and their cost of carries. Okay, how it looks like. So formula for futures. Okay, so okay, and then let us take different asset classes. Okay, so if you have stocks, okay, the fair price of a stock of future is given by, as we have just seen, right? This is F into, sorry, this is S into e to the power RT, T minus T. Okay. Now what happens if it's a dividend paying stock, right? Now let me explain what dividend means and why it affects. Okay. So does everybody understand what is a stock price? Okay, what is the meaning of the fact that stock price is 100 or 200? Okay, or why is it 100, 200? I mean, what is the intuition or rationale behind it? If someone knows, can you explain what it means by stock price being 200?
So it's the auction price that's going on between the buyers and sellers on that particular day or time.
Yes, that is true. But why, for example, if a particular stock price is 100, okay, why is it 100? Why is it not 200? Okay, why are there not in more buyers saying that it should be 200 instead of
So the
100?
market perceives that the stock should be 200 based on whatever factors the market believes in. If the
Yes.
buyers are, if the stock is in high demand, then buyers are pushing the price up.
Right.
If they perceive it as a low demand, then the sellers are pushing the price down.
Yes. What is driver of that demand?
Mm, Whatever they think the driver is, I don't know, but
Yeah. So let me come to the fundamental driver of it. Okay. So the driver is this. It comes from the definition of what's a stock or share price. Okay. So a company makes money. Okay. That is called as revenue or sales. Right. So company has sold something. Correct. To perform these operations, company had to incur some cost. Right. So these are fixed costs or variable costs. Okay. Again, we'll ignore what this means, but for sake of simplicity, you're selling something, there is a cost to something, and whatever is left out of it is profit. Correct? And this profit is equally divided among all the shareholders. Okay, so each shareholder has an equal right on this profit. Okay, so if profit is made of 1000 rupees and there are 10 shareholders, then per share price should be 100 rupees. Right? Now, point is, what is going to happen in future, right? Whether it will continue making this profit until eternity, right? So I'm time t equal to infinity, it will keep making profit, and if you bring present value discount and all of that, what that price is going to be, that is where market disagrees. Okay, but the driver of the share price is essentially this profit, right? So the more the profit per share, right, the more the company will be earning and the possibility of how much it will earn and so forth. Okay, that is what market disagrees, but these are the fundamentals, right? Essentially, this profit is going to be equally distributed between everyone, and that is a prime driver of the share price of a stock. Okay, now what happens is there is another thing. Okay, so let us say the firm has earned an end of the year profit. Okay, so out of it, what it can decide to do is it can decide to give out a dividend. Okay, dividend is a cash back to the shareholder. Okay, so what happens is, let us say the firm has earned a profit of 1000 rupees per 1000 rupees. Okay, and then there are 10 shareholders. Okay, so for this year the profit was rupees 100. Okay, now per share. Okay, now what happens is firm decides to give out 10 rupees as dividend. Okay, so whoever is the shareholder, each share, that person is going to get 10 rupees. Okay, so what happens is this 10 is going essentially out of the same profit pool. Correct? This profit pool was driver of these 100 rupees per share. Correct? Now out of this profit pool itself, 10 rupees is being given as cash, right? So naturally speaking, okay, this 10, this 100 will become 90 per share, right? And this 10 rupees is given as cash to the shareholders, right? So very strictly speaking, purely because of the action of giving dividend, the share price should come down by the value of dividend, right? I hope everybody understands this argument.
so theoretically
Yes,
it should
sir.
come down, but sometimes it might go up also, right?
Yes, like I said, right? It goes up due to hundreds of other factors. Okay, all I'm saying is purely due to dividend. Okay, the stock price is supposed to go down by the value of dividend,
Right.
right? You understand? Everybody understands this argument? Now,
Yes, sir.
despite giving dividend, why it might go up? Because expectation of future profits might have gone up. Okay, so the expected value of stock price might have jumped from 100 to 120. Okay, and due to dividend, if it comes down by another 10 rupees, so you will see the final price as 110. Okay, so what you'll physically actually observe in market is, before giving the dividend the stock price was 100, and after giving the dividend it has gone up to 110. Okay, instead of being at 90, then you will ask, instead of going down, why did it go up? Okay, it went up because this itself went up. It went to 120, but still out of that 120, this 10 was deducted, which was given out as dividend, and that became 110. Okay, so that is kind of not what we are focusing on. What we are focusing on is giving out dividend reduces your value of stock by the amount of which dividend was given. Okay, so what happens to the derivatives market for the same stock, right? So the fair price of the derivative, okay, is supposed to be, since dividend reduces the price of spot, right? So it is factored in here, right? So you do R minus Q into T minus T. Okay. So firms declare the results on quarterly basis. Correct. The quarterly structure which we have in India is you have results March, then you don't have so you don't have an April, May, so you'll have in June, right? So July, August, so you'll have in September, right? October, November, and then you'll have December results. Okay, so firms declare the results on quarter ends, quarterly results, right? And at that point in time, they might make a dividend announcement. Okay, so let us say a firm makes maybe on 1st March, it will make dividend announcement that will be paid on end of March and all of that. Okay, so sometimes what you will see is you have futures contract on so you have a March contract, correct? Let us say March contract expires on 28th of March. Okay, then you have a Feb contract which expires on maybe 28th of Feb. Okay, and the firm has made announcement that it will pay dividend on 15th of March. Okay, so occasionally what you can observe is future price here, right, can be greater than future price here. Okay, as per argument of cost of carry, this should not happen, but occasionally this might happen. Okay, and this might happen due to dividend declaration, right? If there is a huge dividend declaration, so what happens is this happens. Okay, so if your Q starts becoming big, right, if your Q starts becoming big, then your R minus Q becomes small. If your e to the power something becomes small, right, then e to the power that number itself becomes small. So if this is small, then this becomes small, s into this becomes small, right? So for example, if e to the power rt, okay, is equal to 0.999 whatever, right, and e to the power r minus q t minus t, okay, this has to be less than this number, right? I hope everybody understands this argument, right? Because you have an additional number which reduces this number, right? So this, you have this, then you replace this with r minus q, so this becomes smaller, right? So e to the power something smaller will yield you a smaller value, so maybe 8, 9 or whatever, right? So this into spot will give you some future value, this into spot will give another future value, right? So this future value turns could be lesser, right? F2 can be lesser than F1 because the dividend is being paid.
So what does Q denote here?
Q is rate of dividend payments. Q is annual rate of dividend payments. Okay, expressed as a percentage of spot and all of that. Okay, so if firm is paying, if stock price is 100 rupees, okay, firm pays a dividend of 2 rupees per quarter. Okay, so 2 rupees per quarter refers to 8 rupees per year, and 8 rupees per year as fraction of share price represents 8% per year. correct? So your Q becomes 8%. And this is your risk-free rate of borrowing. So let us say if this is at 10%, right? So this becomes 10% minus 2% into T minus T, and whatever you end up with. I hope everybody follows this. Okay. So formula for futures is, formula for futures is, I mean, in terms of explicit sense, right? The more correct or complete formula for futures is into e to the power r minus q t minus t, right? It's just that, not every stock pays a dividend and all of that, right? So okay, so not every stock pays a dividend, but if it pays a dividend, then this is the correct price. If it does not pay the dividend, if you substitute q equal to 0, then you end up with the same formula. Okay, so this is for stocks. Then let us look at another. So like we said, we can have physical contracts, right? So you can have gold, okay, and you can have crude oil and all of that, right? So for gold, crude oil, what will happen is, the regular formula is S into R T minus T, but what happens is there is something that gets added. I'll call that as C and T minus T. Okay. Now this C is called as convenience yield. Okay. Now what does convenience yield mean? Okay. Before we see convenience yield, there is something called as settlement of futures contract. We'll have to see that to understand convenience yield. Okay. Now what happens at at T is equal to capital T. Okay. Now you have entered into a contract at small t, correct? You have entered into contract at small t. The contract expires at capital T, right? And then you are supposed to honor the contract, right? So there are two kinds of settlements. There is cash settlement, or there is physical settlement. Okay, what cash settlement means is, as per our contract, okay, if I was long on stocks, right? So let us look at our payoff diagram. Okay, so if I was long on stocks, right, then as per settlement, whatever is the difference between these prices, S capital T minus small t, right? Whatever is the difference, the winner pays to the the loser pays to the winner in terms of cash. Okay, the other form of settlement is, what he says is, let us say you are long on crude oil. Okay, so at time of settlement, if you are long on 100 barrels of crude oil, what I will do is I will physically deliver 100 barrels of crude oil to you. Okay, so you entered into contract when crude oil was at $80 per barrel. Okay, at expiry the crude oil is at $100 per barrel. Okay, so you were long on 1 barrel of contract, right? So what happens is, the guy with whom you entered into the contract, he has lost the contract, right? I mean, lost the derivative, right? You have won the game. What happens is, instead of paying you 100 rupees, okay, so 100 minus 80, so there are two ways to settle, right? He can pay you the difference of 100 minus 80, or he can physically give you 1 barrel of oil, okay, for which you will pay him $80, right? Because you agreed to pay $80 at the start of the time. So you pay him $80, You take that barrel of oil, you sell it into the market for 100, and you make $20 of profit. Okay, so there are two kinds of settlement. There is a physical delivery, and there is a cash settlement. Now, if there is a physical delivery, the guy who is delivering it to you, he has to store it. Okay, you have to go and physically collect the delivery and all of that, right? So those costs also add up, right? So that is called as a convenience yield or storage cost and all of that. Okay, so storage cost kind of get added, right, to the futures contract. Okay, I hope everybody understands the argument of convenience yield. Okay.
Sir, if the person who won is asking for physical settlement, so how do we know the other person is giving the high quality of the product?
So okay, there is something called as contract specification. Okay, contract specification defines everything. Okay, what is the grade and all of that. Okay, and settlement happen generally via vendor. Okay, so vendor will take care of all of this. But again, as you're saying, that also adds to the cost. Okay, so you'll have to do quality inspection, check, and all of that. Okay. So
that's for commodities, but in terms of like physical settlement of stocks, shares.
So shares does not have anything like quality, right?
Right.
One stock of Infosys means one stock of Infosys. That's what I explained earlier, that the concept of quality makes sense for real assets, okay, not for financial assets. Okay, so just a small correction, it is this. Okay, R minus C. And we'll come to futures FX market, which has an interesting futures price, but we'll come to that in a short while. Okay, so from the part which we have covered so far, right, is there any question? Any questions so far?
So like, for example, let's say sugar is priced low in US and priced high in India. So I can go in this exchange traded market and buy sugar and then try to deliver it from the US to India and then make money.
Yes. Okay, so that brings us to an important point. I'm here to discuss that. Okay, there are various market participants. Okay, there are various reasons for which people buy derivatives. Okay, we'll cover that in a short while. We'll call them as market participants, and you can have market participants are like speculators. Okay, hedgers and arbitragers. Okay, we'll look into detail, a little detail. Okay.
So usually, like I think importers and exporters are doing this kind of a thing, but how like these hedge funds and all are trying to do this? Because they also involving in participation of delivering goods physically?
No,
Right.
like I said, right, there are market participants, there are hedgers, there are speculators, and there are arbitragers. So we'll see that. Okay, what role each of that plays, and how it works. We'll see that.
Excuse me, sir.
Yeah. Go ahead.
Sir, in case of a contract of cash settlement, would there be any convenience yield?
So there could be, okay. There could be. We'll see an example of that as well. Okay. Convenience
Okay.
yield depends upon the kind of underlying. Okay, because convenience yield we talk only in terms of something which can be stored. Okay, and which requires a quality check, right? So stocks cannot have any convenience yield. Okay, they just have dividend yield and all of that. But for example, gold, right? Even if it is cash settled, right? It needs to be. Uh, I mean, technically, there should not be any convenience yield in cash settled market, but sometimes what happens is, okay, you're trading more than what is physically available and all, right? So to prevent all these things, exchanges mandate physical settlement. Okay, so otherwise, what happens is, futures market starts rigging the spot market and all of that. I hope you understand what I mean.
Yes,
Right?
sir, got.
So you want the supply and demand of the availability of the physical spot gold to drive the price of the physical spot gold, correct? And that physical spot gold should drive the price of your futures market, correct? What happens is if you don't have physical delivery, then people can simply bet on the positions, right? So for that matter, for every derivative, right? The very argument of being able to price derivative depends on being able to deliver the underlying. Okay, the underlying can be delivered and hence the derivative can be priced.
Yes, sir.
If the underlying cannot be delivered, okay, then what happens is you don't even know what is the supply and demand for that underlying, correct? Then you can arbitrarily put anything as the price of the underlying. Okay, let me make a new underlying contract, okay, where the price of the underlying is decided by me. Okay, I'll just call it X. Okay, and I set anything. Okay, today I set it as 10, tomorrow I set it as 20. Okay, you cannot have a credible tradable market of derivatives using this as the underlying. Okay, if this underlying cannot be delivered, right? Because
Yes.
tomorrow I'll call that price of that anything. Okay, and what will happen eventually is number of people trading in futures market will be much higher than in the spot market. Okay, so people will start rigging the spot market such that future ever ends up into their favor and all of that. So they'll start uh, rigging the market. That is why you need a credible underlying future which can be physically delivered. But
Yes,
if
sir.
you ask me strictly, can there be a convenience yield in cash settled market? Okay, in terms of an interview answer and all of that. Okay, I will go with the answer that there is no convenience yield. Okay, and you can call that as F is equal to S into E to the power RT. Okay, if it is physically settled, generally which is the case for commodities market, then the convenience yield is added.
Yes, sir, got it.
Okay, so as you can see from these equations, right? So you have a negative term which is getting added. Okay, a negative term which is getting added. So what can happen is sometimes your convenience yield can be higher than R, right? So let us look at this. Okay, R is, this is R 5%, or let us take our example of Nifty 8%. Okay, spot is trading at 21,731. Okay, Q I keep it as 0. Okay, and time to expiry is equal to 1/12. We keep this as a number 1/12. Okay, Now what will be F? F will be equal to S into e to the power R T. Okay, this is all right. This is what we see as the futures price roughly. Okay, 861. Now what I can do is, instead of calling it as RT, I can call it as R minus Q in T. Okay, now Q is 0. Let me put Q as 2%. Became 2. To put 2%. Okay. As you can see, this is decreasing. Everybody can see this. Earlier it was 21,870 something. Now it is 839. If I keep this as 5%, further reduces, right? If I keep this as 8%, it becomes spot, right? And if this becomes more than that, then it becomes less than spot, correct? So if futures price is greater than spot, okay, it is called as contango. This is called as contango. And if futures is less than spot, this is called as backwardation. Okay. You have T and T. Okay. Assume that ST remains constant. Okay. Until S remains constant from T to capital T. Okay. So what is, so if you have F, okay, so F is equal to S into e to the power RT. Okay. So minus T. What I meant to say, this is residual time to maturity, right? So at this point, what is residual time to maturity left? Okay, it is T minus T, correct? So we have this as the futures price. What happens at T equal to capital T? Small t is equal to capital T. So this becomes 0. Okay, so it becomes F is equal to S into e to the power 0 is equal to F is equal to S, correct? So the price of a future at time to expiry has to be equal to its corresponding spot at that time. So wherever the future starts, at expiry, whatever is the underlying price, the future price has to be converged to that. Okay. Sometimes it can start from futures is greater than spot. Okay. If your cost of carry is positive, and then wherever spot goes, it moves, but at expiry it converges. This is called as contango. It might start from here, and then wherever it goes, but here it converges. Okay, so this is called as backwardation. Any questions so far?
Sir, is the spot price known at the start of the contract?
It is known, right? Spot price is known at all points in time during the life of contract. What you don't know is at the start, you don't know what is the expiry price.
So isn't the spot price equal to the expiry price?
why will the spot price be equal to expiry price?
Because
At
as you
time,
said that it converges.
no, at time t is equal to capital T, it is. Okay, so let me write dates. Okay, this is 29th December 2023. This is 25th Jan 24. Okay, now on 25th Jan 24, Nifty is going to be somewhere. Okay, we don't know where. Okay, but it is going to be somewhere. Okay, let us say it is at 22,534. Okay, so this will be your futures price at ST. Okay, but today's future price F small t will be equal to S small t into e to the power R into t minus t. Any confusion so far?
So could you please explain it again?
Yeah, let us write it down. Okay, so time spot futures. Okay, time is 29th December 2023. Okay, what is the spot? Spot is given by this, which is same for all contracts, 21,731. Okay, what is the futures price? It depends on future. Okay, we'll talk only about near month future. The near month future is at 21,861. Okay, now at time expiry, right? So this contract expires on 25th Jan 2024 as per the expiry date of the futures contract. So this contract expires on 25th Jan 2024. As of 25th Jan 2024, you don't know the spot, right? Let us say it is S capital T. Then the corresponding futures price will be